Okay. Hi, everyone, and welcome to the Financial Inclusion Week's global plenary session organized by LEAD on the role of grassroots agents like banking agents or business correspondents in facilitating access of the poor and unbanked populations to financial services, as well as welfare entitlements that are increasingly being delivered via banks and agencies' networks. I'm Tanushri Bhan, and I'm a research fellow in the Financial Inclusion Vertical at LEAD at Kriya University. I will be moderating this very exciting live session today. The discussion will reflect on the returns from this grassroots model, the enabling conditions and characteristics of local communities that have achieved the sustainability of the model across different regions of the global south, and how we may think of designing policy strategies for scaling up agent networks to continuously include more low income rural households. We will also hone in on the financial inclusion and well being of rural women and their households via self help groups or SHGs, and also the work and the unique constraints facing women agents as last mile service providers in their communities. And we could not have asked for a better panel of scholars and policy advocates to draw from their cross regional work to reflect on these issues of inclusion, sustainability, and scalability. We have with us Dr. Ignacio Mas, who's a senior fellow at the Fletcher School's Council on Emerging Markets at Tufts University in Boston, Dr. Sonia Kelly, who's the global lead for research and advocacy at Women's World Banking in New York, Dr. Ranjini Kochar, who's a senior fellow at 3IE and a senior researcher at Stanford in California, and Anand Raman, who's a senior financial sector specialist at the Consultative Group to Assist the Poor, or CGAP, in Mumbai. He joins us from Chennai. A very warm welcome and thank you to our panel for taking the time to participate, especially since it's terribly early in the morning on the West Coast. Folks can learn more about our panel on FIW's website for this session, and please use the chat box to log your questions. In the interest of time, without further ado, I would like to invite Dr. Mas to make his presentation.
Okay, thank you very much. Let me share screen. I just have a couple slides, so it'll be fairly agile. Yeah, you can see that, yeah?
Yes.
Yes.
Okay, so I wanted to focus on agents and the future of agents. I tend to think of digital financial services networks as networks of agents that are connected by a digital network. So for me, it's an agent network with a digital network attached rather than the other way around, which is how people generally see it, which is a digital network with agents attached. I put the agents at the cornerstone of it because that's what touches the community. So first, very quickly, why do agents work the way they have? They have been very transformational in many countries. Well, for two reasons. First, because they leverage existing local resources, as opposed to traditional banking approach of having to build new infrastructure every time I want to serve a new community. So here we're leveraging local stores, local entrepreneurs who see a business opportunity to help others solve their problems and make some money on the side. So it's about the retail, bringing the retail practices into banking. The second aspect is to minimize the credit risk and the counterparty risk so that you can transact in third-party retail environments. And there's the two inventions of the mobile sector, which is prepaid and real-time. If I work with my money always and never do anything on credit, and transactions settle in real time or as close as possible with confirmations coming in quasi real time, then the trust issues go away. So those are the two tricks that have made agents transformational in banking in so many countries. And these two aspects create a virtuous cycle that reinforce each other. So where are the gaps? Where does this not work so well? Well, first, when there's a lack of infrastructure. In terms of banking infrastructure, there's no branches, or road infrastructure. The branches may be near, but it just takes too long to get there because there's no paved road. So that's the need of agents to rebalance from time to time in order to offset the community's needs. So that's a supply side problem. But then there's the other aspect of where there's low transaction density, there's just not enough transactions to make it work economically for the DFS provider. And so that's typically in rural areas. So that's the demand side. problem. In addition, then, if it's costly to provide and there's few transactions, the business case may be made worse if there's multiple operators who divide and conquer. Then that low transactionality, those frequent trips to distant branches through difficult roads becomes even more wasteful. And so here, what we have is a negative cycle of demand and supply, not being able to offer the needs of the community because it's just too costly and there's just too few transactions to pay for it. So how do we address these gaps? So go back to the top of the chart. I mean, are we going to throw more technology at it? Is it a lack of technology? Is technology going to solve that problem? Or is taking more retail practices and leveraging even more the answer? I think the way forward definitely is to double down on retail practices. And in particular, the solution that I think needs to happen is to unshackle the agents from a FSP. If I'm a local entrepreneur and I have a desire to be an agent, I cannot just do it. I see the needs of my community. I see an opportunity to make a little bit of money for myself in serving my community, but I cannot do it because the operator or the bank may not give me a license. So if you unshackle the agents from the FSP so I can operate independently of the bank or the operator, then you can leverage a variety of business case thresholds. I'm just a young, dynamic entrepreneur locally. This works for me. It may not work for the operator, and that's why they're not giving me a contract, but it works for me. I'm making enough money to make this worth my while. There's also a variety of operating models because the telco or the bank might have a standard view of what an agent is, whereas I have a different model. I do door to door, or I operate in less traditional environments. I work certain days of the week. So you introduce more variety that can help make it work. And then, of course, the big thing about unshackling the agents from FSPs is that if you're a retail outlet, you have a vocation to be multi-operator from day one. You're not going to be interested in only serving one operator or one bank. You want to serve them all. In the same way as in your store, you have a variety of toothpaste, a variety of goods, and don't stick to just one brand. So if you unshackle them, there's a natural vocation of agents to serve all banks and all telcos. So at the end, it's like if you sell rice. If I sell rice at my shop, am I an agent of the rice company? No, absolutely not. I just happen to have bought an inventory of rice and I'm selling my rice for cash. So the idea would be the same for digital finance. I have some cash, I sell it for digital money and make some business. Now, so what I'm talking about is introducing a notion of independent agent networks that have a right to exist independently of the agents. If I have a connection to the DFS provider because I have an account, I have the mobile phone and the connection, then why can I not make that work for the community? Now, this need not be unlicensed. You can make these independent agent networks licensed and regulated, in which case the analogy is less the rice buying and selling, but the pharmacy. The pharmacy is the pharmacy an agent of the pharmaceutical company? Absolutely not. In fact, you may be horrified at that thought, even that the pharmacy can only sell or must push the products of a particular pharmaceutical company. They're not. They're not agents of the pharmaceutical company. They're still licensed and regulated through a process that makes sure that they do the right thing by the customer. So it would be the same thing. These independent agent networks should be regulated and licensed, but as independent businesses. Then any agents that they sign up would be under contract and supervised by them, just like it happens today, except that now it's done, they're linked to FSP providers. Whereas what I'm talking about is there's separate licensee of the central bank agent network, and you just want to work with them. Why? Because as a retail store, they give me many more facilities. They don't impose their business model on me, and they let me work, and they make it possible for me to work for all banks and all telcos at the same time, rather than the opposite. Otherwise, the system is the same as today. So there's still a whole licensing system, but the licensing doesn't flow through the FSP provider. It comes independently. So that's what I think needs to happen to let agents flourish. Let them is much more of a bottom-up approach. Let young entrepreneurs who see opportunities, solve problems for their community, rather than having them to beg with FSP providers to give them contracts, which they may not do. Now, linked to this is the discussion of what do agents do? Well, I break it down into 4 categories. They give cash. They buy and sell cash for digital money. They may serve as a mailbox, just passing documents from the customer to the FSP provider, for example, in loan applications, documentation. They might actually check IDs for KYC. And they might be involved in cross-selling or upselling other financial products. Now, these are very different activities. And I'm always very hesitant when we put everything into one lump. These two have a clear agency aspect, because the incentives to comply are not the same. I mean, whether I check the ID properly or not, it doesn't impact me at all. It impacts the FSP provider and the central bank, but it doesn't impact me. So I need to be supervised. I cannot be trusted to do the right thing by the customer, because I may be friendly with the customer and I just don't want to give them the hassle of having to bring ID. In the case of upselling, there's a risk of mis-selling. I want to sell as many products as possible, get commission, and I might mis-sell certain loan products to certain categories. So these two activities have to be done under agency from the provider. But these two are not. These is much more of a commercial transaction, a normal merchant transaction, because they're spot transactions. If I buy and sell cash from the community, I do it from my own account. I'm not doing it for the mobile operator. I'm not doing it for the bank. I'm doing it because I see an opportunity to make money out of my cash balance. And so the incentives are aligned. I want to do the right thing by my customer because it's my customer. The moment we turn this into an agency, we're eliminating the customer relationship. And so by turning into a merchant relationship, we are able to then make the market discipline work for cash in, cash out. Because if I am not providing the right change, obviously customers will stop coming to me. Just like if I don't weigh my rice properly, customers will stop coming to me. So let brand work at the last mile. Mass cash means reliability, means I have cash all the time. Let that stand for something, because just sticking a bank logo on my store communicates nothing to the customer, because it doesn't say necessarily that I'm a reliable agent, that I'm courteous, etc. So bring branding into the business. That's the best way to provide service to the community. The only important thing here is that the merchant does this on an approved DFS platform, but that's what I do because I'm using my mobile phone to communicate with the customer. Confirmations come with the on the phone of the customer. So clearly, the trust is provided by the third-party network. The trust doesn't need to come from the agent owned or working for that provider. So I wish we stopped using the word agents. These are 4 different activities. I think we need to unbundle, at least logically, what the notion of an agent is, and we need to free the cash networks from the tight control of the mobile operators, the banks who don't want to offer interoperability to other banks, who want to remain to retain exclusivity by hook or by crook, and really don't care about communities where they personally don't see a business case. So that is what I wanted to mention. So this idea of freeing the cash networks, let them operate independently, and also this idea that we need to have a much more nuanced discussion of what agents do. I personally do not see agents, or let me call them merchants or stores in the neighborhood selling financial products. I just don't see that. I think that's the business of the financial service provider. Let them build little stores or have other channels, much more under their control. But individual mom and pop shops, in my view, should not be offering selling financial products. They should just be selling cash on their own account. Thank you.
Thank you. Thank you, Dr. Moss. If I can invite Dr. Kelly to make her presentation next. And
Great, thank you. And thank you so much, Ignacio. I felt like I was back in that Digital Frontiers Institute course. So that was really fun to hear your thoughts. Unsurprisingly, I'm going to be focusing on gender, and that's unsurprising because I'm Sonia Kelly and I lead Women's World Banking's global research and our team of researchers and network partners around the world. So I thought it might be appropriate to complement the other speakers by focusing on the gender perspective on this topic and thinking specifically about last mile delivery of financial services and welfare programs for women. And in the title, we defined both last mile delivery of services, implying agents, and also welfare programs. Before I get started, let me do just a very quick introduction to Women's World Banking. Women's World Banking is a globally focused institution that pursues women's security and prosperity through access to and use of financial services. We do this through investments, through advisory services with financial services providers, through knowledge sharing among our network member institutions, and through research, which is where I come in. We're headquartered in New York, but we are very global, and our countries of primary focus include Mexico, Nigeria, Egypt, India, Bangladesh, and Indonesia. I'll focus a little bit on India, but also pull in some examples in my remarks from Indonesia as well, which I think is another interesting market where we've been looking at this topic. I think this topic of last mile services for recipients of social protection is really interesting and very timely. Women's World Banking has been working in this area for years, but our focus increased a great deal with the felt economic effects of COVID-19 and resulting social safety nets. According to the World Bank, nearly every government in the world created some kind of social protection program in response to COVID-19. And in the spirit of never waste a good crisis, which I believe was a Churchill quote, but has been a bit overused, and so my apologies for using it again. But in the spirit of this, we've been working closely with social protection recipients in those countries of focus, and we're able to monitor and advise on the channels through which this support was distributed and resulting follow-up. I think this conversation is also high stakes with significant impact on women. In India, for example, just 3 months into additional support provided by the government of India to women, more than 25 million new accounts were opened, like just an enormously rapid speed. And I know in the context of the whole population of India, 25 million is a relatively moderate proportion, but to open 25 million accounts within 3 months is really significant and requires support of last mile institutions and persons, not only because of networks of trust that, like Ignacio talked about, agents being the ones who are best positioned to know the financial needs of people, but also because of this unique moment we're living in where social distancing is mandated by governments, there are lockdowns, and people just can't travel very far from their homes, or couldn't, especially at the beginning. So Indonesia's social protection program as well, I mentioned I'd be referencing that. It has been distributed in a range of ways, financial and otherwise, but in response to COVID-19, Indonesia shifted all of its programs to people receiving money through accounts instead of through food aid or other things, and covered 10 million households through their PKH program or PKH program, with funds being distributed primarily to women in the households. The timing as well is fortuitous in the arc of the broader financial inclusion conversation. We as a community, I would say, have been working on on-ramps to financial inclusion from G2P payments for well over a decade. And I think some of us were probably about to give up. And I think this particular moment with so many people having been just brought into the financial system, and especially women, this is that kind of make it or break it moment for this particular channel to lead to meaningful financial sector engagement for women. So there are many tools we see in our work in engaging with social protection beneficiaries, all with implications for last mile delivery in general, but especially for last mile delivery to women. And the first is the use of distributed access points. In India, our partner Bank of Baroda leverages an extensive network of business correspondents. These are people who are part of their communities and tasked with nearly all of the transaction functions that someone might find in a bank. These are exclusive to Bank of Baroda. So Ignacio made that distinction between agents who are exclusive and agents who can serve multiple institutions. These agents are exclusive to Bank of Baroda. And we find that women are comfortable going to the business correspondent or agent, in part because they are more approachable. So you might be willing to ask them a question that you don't feel like you can ask in a bank branch where there's a long line of people behind you. They're more convenient. They're like in closer physical proximity. There's increased trust in the community when you go to a business correspondent and do other things. And you see them every day, and so it's not a random teller. It's the person that you know. And then, as Ignacio shared, they're capable of tailoring products and recommendations to customer needs. We also find another tool that's frequently used, and that's delivery of financial capability messaging through people that customers or beneficiaries trust. So in Indonesia, we did a survey of recipients of social protection payments, and we found that only 8% of them were actively saving on the accounts through which they were receiving payments. We worked with facilitators of family development sessions. These were sessions where they brought together recipients of social protection and talked about the benefit of education to children and nutrition and those kinds of things. We worked with these facilitators to deliver financial capability messages to people and share features of the account beyond withdrawals. And we saw a substantial increase in awareness of account features like savings or making payments. There's also the tool in the toolbox, training and capacity building for agents themselves. In India, we're training and incentivizing these business correspondents to nudge customers to store more value on their basic accounts. In Pakistan, just to give another example, we spent time doing ethnographic observation of recipients of Jazz Cash agents. An ethnographic observation means we just had researchers who are sitting there in the agent's shop and watching what happened. What we found was that women agents were more likely to spend more time with customers, with implications for how prepared customers felt to perform transactions on their own, rather than, for example, giving their card plus a paper with their PIN number on it to the agent. And as women, we know, tend to prefer more training before attempting transactions for the first time. This was key to customer success, and we were able to integrate some of what we learned into training for agents with success and financial capability, trying to replicate what we saw with the best women agents, trying to replicate that across the agent group we were looking at. So I'd love to take my last few minutes to highlight kind of where we're going as an organization, as Women's World Banking, because I'm on a panel with some really great thinkers, and it seems like a good time to bring up a set of research questions that are top of mind for us, that I don't know that we'll have time to discuss today, but maybe together as a financial inclusion community, these are ones that we can work on. One is, how well do last mile financial services facilitate women's economic empowerment? So as we at Women's World Banking engage with social protection programs, if we can find evidence to support the relationship between the financial inclusion aspect of social protection delivery and women's economic empowerment, we might find even more support for financial inclusion among social protection programs. But there is this concern that as you get further and further away from the center of financial services, as you get to the periphery, that financial services get quite thin. People are using one product instead of three. There's less incentive on the part of financial services providers to do things like cross-sell. And so that's a question that I have about how well that leads to women's economic empowerment. Second, how might we translate G2P payments or government to person payments into meaningful financial inclusion for women? This is that question we've been working on for over a decade, but I'm hopeful that with this new influx of people into the financial system, we might have more examples of how that happens, how people move from having an account through which they receive funds to engaging with loans and payments and savings. Third, how might conflicts between the goals of social protection programs and the requirements of financial institutions be resolved to increase focus on financial inclusion? And finally, this one is, I think, the most important. Does gender matter in agent-customer relations? And I don't just mean, are women better agents than men agents? Although that would be a very interesting question to explore. But there are a lot of aspects to this. Does gender matter to customers in a context where there are strict social norms? For example, do women customers prefer going to women versus going to men? Does gender matter to financial services providers? And is that something that we should rethink as an industry? Does it matter in terms of relationships between men and women? So if there's a woman agent, is it different for her to serve women than it is to serve men? Anecdotal evidence from other countries, like in Zambia with the Zona agent network, for example, we see that they specifically try to recruit women agents, and they pose the idea that women agents are better at serving both men and women than men agents are. But that's something we really want to look at more in our work at Women's World Banking. So I will pause there. There's so much more we could discuss as a group that I'd love to pick up on, but eager to sit back again and listen to the rest of the panelists. Thank you.
Thank you. Thank you, Dr. Kerry. Dr. Kochhar, if I can invite you to make your presentation next, please.
Thank you, Tanushree, and many thanks to LEAD for inviting me onto this panel. I'm actually going to pick up on the point that Sonia raised, the first research point she raised, and that question is, how well do these systems work? And my talk is going to be focused on that question. It's actually not going to be focused on giving you evidence on how well they work. I'm going to start with the claim that much of the research finds that it doesn't work very well. And so my talk is going to be focused on trying to explain this. What can we do about increasing the returns from last mile delivery? And I'm going to focus my talk or draw on India's experience with self-help groups under the National Rural Livelihoods Mission. So all my examples are going to come from there, but hopefully they have broader applicability. I'm going to make three broad points in this talk. The first point is that the returns to financial access do reflect what is, I view as a traditional view of the relationship between scale and market size. And this gets back to some of the comments that Ignacio made as well. The traditional view and what underlies a lot of the returns is that the ability to exploit economies of scale, and hence the returns from any of these providers, depends on market size. For households, obviously, if you have a very small market in which you're providing your products, the returns are going to be low. But the same point is, as I said, the point that Ignacio made, it's true of business correspondents and agents. If they are serving a small market, if they are serving a poor market, the returns from their the returns to them are going to be low. And as a result, you're going to see that the quality of the services they provide is similarly low with low returns overall. The second major point I want to make is that market size should not be taken as and does not reflect population size. Okay, so if you take even the smallest villages in India, and India's villages in North India in particular are small, the average size is about 1,200 population, which is slightly over 200 households. North India is very dense in terms of villages. So we geocoded all villages in India to identify the characteristics of all the network of villages within 10 kilometers of each other. It turns out that every village, even the smallest village, is within commuting distance, 10 kilometers, of a much larger village. And the average size of these larger villages is 5,000. So even though you reside in a small village, the market you face is actually fairly large in terms of population. The real constraint is that the market is not necessarily large in terms of income. And you can see this best by looking at levels of schooling. The variation in schooling within a state in India varies quite considerably across states. But you have states like Bihar, where the average schooling level in a village with a population size of 7,000 to 10,000 is identical to the average schooling of a village with a population of 1,000 or less. There is almost no gradient in population size and schooling, which means that if you go to larger villages, you're literally just going to blow up of your village, but equally poor with no purchasing power. And this really is the driving factor. The third point is that this variation in schooling between villages has very, very large effects. And the reason for that is there's a fundamental change, I think, in how we are now thinking on the policy side of the relationship between scale and market size. So this goes back to that traditional view. The traditional view takes market size as given. That's the size of your village or broader the regional economy, and that the program returns are limited by market size. The new view, whether it's recognized officially or not, is that market size is endogenous and that policy can increase the size of a village's market by implementing a program at scale. Okay, so we're shifting from scaling. When you normally think of scale, you think of extensive scale going geographically across geographies. So moving from one village to extend to the next village to the next village. There's a different thing that is going on now, and that is scaling intensively. So instead of thinking of moving from one village to another, you're thinking of mass coverage of the village or pulling in all the households in the village. That makes a big difference. There is what I refer to as a scale multiplier. The effect of variation in schooling across villages gets amplified because now it affects this endogenous component of market size. It affects the ability of policies to increase market size. So let me explain what I mean by that. There's a well-recognized problem of implementing a program at scale. Administrative quality drops off as you go from, say, larger villages to smaller, more remote villages. This is more critical when you're scaling intensively. The constraint it causes is more critical. You now need to ensure, as an example, you need to ensure that the 20 SAGs you have set up in a village all work well. So you need a lot of administrative capacity in the village, not just to ensure that one self-help group is working, but that the whole village is covered and that all of it is working. There's a paradox here, which I don't think has been well recognized. The more that this administrative quality drops off across villages, so that greater the variation in capability across villages, the easier it is for policy to address this. Policy becomes more effective when you do have this drop-off. And the best example is India's National Rural Livelihood Mission. NRLM has put in place a very innovative set of features to deal with this drop-off in quality. And the two main things are a federated structure. So you take all the self-help groups in a village and you federate them at the level of the village into a village organization, and then at a higher level into cluster level federations. And the second aspect is communitization. When you hire the most educated women from every self-help group, form a community cadre, and then use these women to ensure the quality of self-help groups within that broader region. Okay, so federation takes all the self-help groups in a village and basically puts them under one umbrella, so ensures equality across self-help groups. So if you have a lot of variation in education or capability within the village, that works really well. But what if everyone in the village is equally poor? there's going to be no impact. You're going to stay equally poor. The same thing of communitization. You're hiring the most educated women in a block and using them to monitor self-help groups across the block. If there's no variation in education across the block, you end up with a system that makes no difference. But if there is a lot of variation, then you can significantly address this last mile component. So the real problem is in villages where there is variation schooling, say in broad regions like north versus south of a state, but no variation within these. And that is exactly the case in many of India's poorest states, including Bihar. So we are drawing on a survey which considers a region of Bihar known as the Kosi region, which is very poor, and then some districts from another part of Bihar which are not so poor. We surveyed self-help groups in these two regions, and we find a huge difference in the quality of self-help groups. They are much lower, so this is sort of maps onto agents or business correspondents. The self-help groups are much lower in terms of the financial activity they undertake. There is less borrowing, there is less saving, there's smaller loans, there are fewer loans. Just about by every metric of financial activities, self-help groups in Kosi are doing much, much less than self-help groups elsewhere. And not surprisingly, their impact is much lower. What we find from our research is that this difference in self-help groups across these two regions of Bihar reflect these regional characteristics, including the existing levels of implementation in other villages of the bloc. The second finding from our research is that low self-help group quality reduces the financial viability of self-help groups and the ability of the program to scale within a village. This sort of comes back to why I think addressing returns is so critical. If you're a woman or a household and you're borrowing from an institution and the returns are not guaranteed, access goes out. You're going to drop out of that program. So to provide access without paying equal attention or even more attention to returns is going to be counterproductive. What happens is that low quality affects a member's commitment to that institution and hence the growth of the program within a village. In Kosi, the coverage of the village has been remarkably difficult to achieve as compared to other regions of Bihar. Okay, so the third finding from our research is that scale matters. Okay, it matters in Kosi that you have not been able to cover the whole village, and it matters in several broad metrics, but the metric that we have looked at in our recent set of papers is that it affects the growth of consumption expenditure. So that basically it affects the growth of income for any given household. And at a village, it also affects the variation in consumption within the village. Both things are detrimentally affected by this inability to ensure coverage or scale. The conclusion is that we need to change how we think about delivering financial services to the poor. At a very simple level, we can't deal with access and then turn to returns. I actually think it has to be reversed. You can't talk about access if you're providing a low quality product. No one is going to take. How do we do this? Planning needs to be much more local. We actually pride ourselves in India that we do decentralized planning, but decentralized planning in India has come to mean that we implement the same policy, but across the region. It has to be much more local, and data now allows us to do that. We actually have to look at conditions in groups of villages, these networks that I talked about. Or if we have to, we can go to the block instead of focusing on districts and states. The second point for policy is, I emphasize this over and over again. If you're going to make an impact on poverty, and if you're going to make an impact on inequality, these are big terms, but the only way we can do that is by breaking the local connection. So we've shifted to local service providers. We are reinforcing the local connection. So we're taking households in a poor area and we're giving them an agent who is equally poor off. Unless we break that, we're not going to have an impact. For research, you'll understand, or you from my comments, I think we need a different research agenda. The questions that come up when we approach things on scale, when we think about these broader issues of what we do about poverty and inequality, are fundamentally different from a literature which just says, what is the impact, and can I show you that this had an impact? It really gets at pathways, and the pathways, again, as I said, are fundamentally different. Thank you.
Thank you, Dr. Kochar. Anand, you're up next.
Okay. I think there's so much being said by a lot of the speakers, and so much of it very relevant, very valid, that I am fortunate that I don't have to go through some of these things again. So I'm going to take the task of summarizing some of the points that were made. First, I think there seems to be at least one thing that we all agree is that there is a need to promote some combination of service providers who are local, capable, so that poor people, underserved people end up getting a broader range of financial services to build resilience and capture opportunities. I think that's a kind of non-controversial statement that I'd like to start with. The other thing that I think most of us agree with, to a lesser or a greater extent, is the degree of challenge in achieving viability. Dr. Anjani just talked about the fact that if the economy itself is very small, then the market size, as she was saying, it's very hard for the agent to really make too much money. And so that's kind of the idea, that the challenge of building the agent model, and I'm kind of really talking about rural agents, remote rural agents, in fact, even, where the challenge is, from the demand side, it's an access challenge. From the supply side, it looks like a coverage challenge. But clearly, there is a viability issue. I'll quickly go into some research that CGAP did that I'd like to present a summary of, which really we looked at 5 different countries in separate continents. These were China, Colombia, Kenya, Indonesia, and India. Fairly large markets, fairly mature markets in many ways. The whole idea of agent networks has been around for almost 15 years now, and with varying degrees of success. And it's remarkable that in all of these contexts that are so different, with very different starting points, the journeys that different people have taken, different countries have taken, have achieved some commonalities. And we'll get to that in a second. Despite all of that, I think it's worth just acknowledging for a second that it's not all gloom and doom. There has been a fair amount of success. I mean, I think we've kind of beat ourselves up a little bit too much. It's not all bad news. There is a great deal of good work that has happened because of agent network expansion, and whether it's transactional agents or agents that are actually doing some really more solid financial services, loans, other kind of work, a lot of that has already happened. And I think it's worth acknowledging the contribution of millions of people who are working as service providers as well as agents in doing that. Now, what we have done is, as quasi-academics do, we have kind of captured these findings into what we call, let's say, stylized journeys, for want of a better term. And there are 3 of these, and they're kind of divided into 2 parts. One is the use case. What's the use case that really drives agent network expansion? That's one part of it. And the other is, who is the service provider who is very good at doing that use case, right? So this whole business of unbundling banks versus, should banks be offering it? Should it be dedicated, non-dedicated? That's the other axis. And there is a subplot here, which is really about, the business correspondent who has an office or something that almost looks like a bank branch versus somebody who's transactional, doesn't look like it. And to the extent, Ignacio is saying, why do we need anything at all? Let those who wish to serve. Right? So that's kind of the other one end of the spectrum. And the other end of the spectrum is the bank saying, no, this guy needs to end up passing a qualifying examination after reading a 200-page book, and unless they clear the examination, they can't sit there as an agent, right? So this kind of that's kind of where we have in terms of the spectrum. And add to this the vast contextual differences that come in each of these markets. And India, in particular, as Anjani was saying, is 1,000 countries in one. So that's why decentralization is important, because what decentralization really means is you respond to context rather than look at some central planning outcome. So just very quickly talking about each of these journeys and where we found them. The P2p journey is really domestic remittances. Migrants are everywhere. They send money to their families. That drives agent networks. It's a kind of the demand kind of speaks for itself. So Kenya was, M-Pesa was the first one off the blocks. You had Wave Money, Myanmar, you have Bcash in Bangladesh. So that's one model that has driven this. Even in India, where it's a bank-led model, some of the early providers, with one of whom I was actually employed, was driven by this whole business of domestic remittance. So that's the P2p journey, but you'll find more examples of it with either an MNO as the service provider or a third party as a service provider, not bank-led. The other one that so number 2 is the government to person social welfare payments kind of logic, which really Colombia started off. India kind of followed that model. China did a lot of it as well, and this is very bank-led and bank-heavy. So there's a huge amount of public infrastructure in bank branches, in making sure that cash is not too far away, so that when the government actually sends out those monies into those bank accounts, there's a lot of other infrastructure. You need identification, you need KYC that needs to be done reasonably easily, either because you have a birth registration system, or you have, like in India, you have an Aadhaar system, which, as Sonia pointed out, allowed 25 million women to open an account in a very short period of time. So you need to have some of that infrastructure that enables some of this stuff. So that's the government to person welfare payments led journey, which kind of creates a flywheel effect, if you like, in terms of agent viability. And the last one is kind of out there. It's really only succeeded to some extent in China, which is built on top of a public banking infrastructure that really pushed account penetration very deep. A wave of third-party private providers came in with e-commerce as a real proposition, and that allowed a lot of these transactions to happen. So we call that the e-commerce-led model. And Indonesia wants to go in that direction. Still, the jury is kind of out on that. Sorry, excuse the plane that's flying over the building. Give it a second. So in China, the G2P, the e-commerce model is kind of the most mature. In Indonesia, we still have to see it. I'll very quickly summarize, come to the end of it by talking about 6 policy and regulatory implications that are similar, that in one way, shape, or form are a commonality or a thread across all of these markets. The first one is that public investments are critical for agent expansion at the last mile. And I think it's kind of a no-brainer. It seems very simple, but it bears a mention that public investments, there's almost nothing that we have done in humanity that hasn't been preceded by public investments, whether it was flying off to space or anything else. But clearly, there is a big role that public investments has to play. The second is that the G2P example, welfare payments, that conversation is kind of picked up. It has been accelerated because of COVID, but the welfare payments logic is getting more and more traction, and there is room to believe that greases the wheels a little bit in terms of making sure that the initial there's no initial transaction. You don't have to find out what the demand is. People are going to come and withdraw the cash that's been sent to them. Right? So that's the G2P model. The third thing that we have found is that where you have a little bit more of a, I don't want to say relaxed, because you don't think of regulators like that, but where you have an approach where regulation is a little bit more open to experimentation, it allows testing of who can be an agent, what's the criteria for me, what hoops do I have to jump through in order to be an agent, if those are relaxed. And that, I think, really is a debate on what is the risk that the agent is representing to public deposits. To me, that's kind of a simple sentence. Is there a risk to public deposit? Is there a risk of fraud? And you assess that, and then you decide these services can or cannot or should not be offered by a particular type of agent or not. Right? The next one is again somewhat recent. It is that data on agents can accelerate expansion. And it's a no-brainer, but in the last 10 years with Google Maps and a whole bunch of GPS-led initiatives, it is much easier for us to put on the map what does the access network really look like. So going back to what almost Ignacio's opening comment was, he looks at agents linked to a digital network, and that's really, you can visualize that network by putting them on the GPS map, by saying, okay, there's too much density here. It's not going to work, because if you put one more agent here, the other 4 who are dying will definitely be killed, right? Put that two agents somewhere else, because that's where the demand is, or that's where the economy can support it. Another one that's kind of commonsensical is developing compelling use cases. And this goes back to the decentralization point. There's nobody who can sit in an ivory tower, in London or Mumbai or in Chennai or in any other city and say, oh, this is a great product. It's going to work for everybody. It just doesn't work in financial services. It's very important to understand what local demands are. And therefore, compelling use cases kind of arrive out of that. There are some of these MVP use cases, if you like remittance that are universal almost because of human behavior. But beyond that, you can't be a one product horse. You need to diversify, and therefore you need to find compelling use cases. Credit, of course, is kind of the one horse town for financial services in many cases. But everybody in this panel and financial inclusion wishes that financial services providers expanded beyond just these two. And the last thing that I want to add is, again, maybe Ignacio was referring to it, is customer service. So I think it's very important to understand that unlike, say, mobile telephony, where if I buy a SIM card from some guy on the street, I don't blame him when the SIM stops working. I blame the network provider. It's very clear to me who's at fault here. But if there's no cash with the agent, I blame the agent. So the service provider is the person at the last mile. It is not some woolly thing that is sitting on network and digital. And if I tell him, oh, the network server is down, he's still going to curse me. It's my fault. It's that I didn't get service, not the bank's fault, right? So I think it's important to understand how you resolve some of these issues in terms of customer service. And I think I'll stop there.
Thank you, Anand. Before I jump into the questions, and some of which are my own, thank you everyone for your excellent presentations. I think Sonia had a question for Ignacio. Sonia, if you would like to make that
Sure,
question.
maybe this can kick off a discussion with all of us. I was really interested, Ignacio, by your comment about FSPs or somebody having to make the decision about unshackling agents versus leaning into technology as a proxy for agents. And I would love to hear from you, but also from everybody else, if you have an opinion. What is the medium to long-term future of agent networks? Like, is there a future in which there might not be agents, or will we always have agents? And if not, what is the timeline? I think the context to this question is, when we first were talking about agents, we sort of were talking about them as a bridge to digital. Like in Kenya, we were talking about cash in, cash out agents, and you need to invest in that for a few years, but eventually people will get the hang of just using their mobiles for everything, and that hasn't been the case so far. You're on mute. Ignacio, you're on mute still.
Sorry. Yeah, thanks, Sonia. In the very long term, perhaps there's no cash. But if you look at what agent networks and mobile money systems have done, where they've been really successful, like in Kenya and many other countries, it's not better than cash. It's better cash. Cash is supremely efficient in Kenya because you can procure it anywhere. It goes anywhere. And so it's made cash so much better. I think that's the secret of M-Pesa. It's not that it's better than cash. It just made cash work better, because the reality was no one was looking into the distribution of cash into local ecosystems. Now we have someone looking into that. So I think cash is here to stay, especially where people work in the informal economies. So I am totally of the view that the objective is to make cash work better. And if cash works better everywhere, you'll see tons of innovations of the decentralized kind that Anjani and Anand were talking. And this search for the use case, I think it's legacy is going to become legacy thinking. Once there's cash works everywhere, there's going to be so much bottom-up innovation that different applications will come up, a bit like happened in India. The cash problem was solved first through the postal network, and then there was over-the-top digital innovation. That's how I see the logical sequence of events, rather than starting by us figuring out a use case.
Thanks. Anjani, Anand, anything else to add here?
Yeah, I don't think agents are going anywhere anytime soon. I think I speak from being in India. This is, the idea that So cash is not like analog cassette tapes, which people of my generation will remember, that went away, and then you suddenly had CDs, and then now you have cloud. It's not like that. It's a completely different animal, and it's been around for longer than most of us have been around on the planet, and it will continue to be. I think that there's a different. There are a lot of benefits of cash, and agents. Their primary function is converting cash to something that can move really quickly, which is an accounting entry. That's what they do. They take your cash, make it into an accounting entry, and off it goes. So the wire that converts it, I think. And the other thing to remember is that this is a journey for somebody who is non-literate, who is. It doesn't mean that they are incapable of doing certain things. You can perfectly live an entire life without the formal schooling that has been drilled into our thing. There are many people that I personally know who are like that, and it's important that there is an interface that allows them to navigate this without condescension and with good customer service. And therefore agents provide a very important service. That's why there's been so much of commentary about, let's make it local, let's get somebody who understands it, let's get somebody from the milieu, let's somebody who understands the community and is at ease with them, rather than ship a banker from somewhere who hates being there in the first place and then does a bad job of it. So that doesn't make any sense. So I think agents will stick around, and like Ignacio said, cash will stick around for a lot longer than a lot of us imagine. It's got nothing to do with poverty, of course, because Japan is full of cash, and so is Germany. Nothing to do with poverty. It's just what you're comfortable with. But I think agents serve a very, very real, like I said, it's worth acknowledging. They've served a very valuable purpose. They will continue to do so. And those that do will continue to stick around for a long run.
Just taking off of what Anand just said about agents always being there, and I want to ask a question which is focused on the two gender experts on the panel, and that is looking at women as last mile service providers, and what are some of the risk mitigation approaches that we can think about when we are thinking of women as the ones who are on the field providing services. And this draws primarily from our ongoing work in rural Chhattisgarh, where we find that serving low-income citizen client base carries an economic risk for women agents, which is, they work off of application submission fees where they're enrolling households into welfare programs, and oftentimes they don't get paid on the spot for processing applications because either the households are too poor or they don't trust the government institution to actually deliver the entitled benefits. So in those cases, women have to make out-of-pocket expenses, and sometimes they get paid later when beneficiary households receive their entitled benefits. So the volatile incomes of women also result in another kind of risk exposure for them, which is what Naila Kabir calls the patriarchal risk, where when their incomes are volatile, they also face a lot of family tensions, where the households are not very happy with the work that they are doing because they are working outside homes, they're working long hours to make these applications, and their incomes are volatile and sporadic, if at all. So I was just wondering, based off of whatever we've learned from these BC type models in other parts of India and in other parts of the global south, how can we make these business correspondent banking agents type of models work for women that allows them to be employed in paid work outside their homes? If anybody has any
Yeah, and I don't think that's a question just for those of us on the panel who are focused on gender, because I think it's a very good question about reducing income volatility for agents and making sure that that the agent model is a viable business case for the agent themselves. I think your research sounds fascinating, and I'd love to read more about it in the case of Chhattisgarh and income volatility among women agents. I think that the only complementary piece I would add from our research is that right after lockdowns in India, we found so agents were, or business correspondents were allowed an exemption from having to close because they were part of the financial system, and the financial system was allowed to stay open, whereas other non-essential businesses were required to close. But what we found was that women agents tended to keep shorter hours at their place of business, or to decide not to open. And our hypothesis is that this was happening because of women's unpaid care responsibilities at home. And so that it just sort of complements the very the much more relevant findings that you had about income volatility among women agents and multiple roles that they take on, much of which is unpaid in the home. So yeah, that's the only thing I would add, but I wonder if others have more to add.
Jump in terms of just maybe rephrasing your question, Tanushree. I think the question you posed was, are women more at risk or more affected by vulnerability in income than are men? So that's where the gender issue comes in. And I think the answer has to take into account what the alternative is. So it's easy to say, yeah, of course they're more at risk, but the incomes that they're getting as business agents, that may be volatile, but is that less volatile than the income they were getting otherwise, or the lack of income? And in that sense, even though it's volatile, it's actually reducing the volatility of income. So I think the only way you can judge that, and the first comment that are women more at risk, is really looking at what was the alternative and are they better off in that. So I guess it's just coming back to this, exit option or this decision to participate in an institution. If a woman has taken up that job, it has to be that she is better off in that. It doesn't mean that she's well off. There's always policy that can address it and make it even better off. But I think we need to be also aware of the alternatives.
Yeah. And I think we are almost out of time. I mean, we are out of time. We are a minute over. But yeah, I had another question on sort of looking at these agent networks that are fundamentally established on trust between the agent and the service providing institution or the operator, as Ignacio put it. I was wondering, especially when it comes to government services, if there is a trust deficit between the citizens and government institutions, what are some of the ways to think about sort of sustainability of these agent networks and scalability thereafter, if the panel has any thoughts on that?
I'll add a quick comment on that, sort of relating it back to my talk. I think the question of trust becomes much more pertinent when there are no returns from a project.
Yeah,
right?
exactly.
I mean, you've gone into an institution and that institution has failed, or a cooperative has gone defunct. That's when we lose trust. So again, I think the need to ensure that the institution produces returns and works is fundamental to trust. Trust is something that doesn't exist outside. It's not like a social norm, which is different from what is going on within the organization.
Yeah.
My view when it comes to trust is that we have to separate sales and service. We want to find that channel that solves all our problems. And because we have these agents that do cash, they can also give advice and they can also check IDs and they can all sing and dance and do everything. The reality is most businesses separate sales and service channels. If you have a Samsung phone, you'll go to a Samsung store to buy. You don't go to a Samsung store to repair. It's a separate channel. Because the trust is different when you're buying something new that you don't understand so well versus when you want something fixed or you just want some cash. So that's the core distinction that I would make. We need to separate sales channels from service channels because the sales channels requires trust, agency, lots of training, good information, oversight, where service really do not. It's a very spot transaction. So the answer to your question, they should use, for government services, they should use the same service channels as every other cash-based need or financial service, but the sales channels should be entirely different in terms of how do you reach out to the people, communicate the service, follow up on any doubts they might have, and so on.
Yeah. I'm getting a prompt from Ariel that we are at the end of our time. And thank you all so much for being here. And this was a very, very rich and insightful discussion. And sorry to some of you who had to wake up super early to participate. But thank you so much for joining us. And it's been a pleasure to moderate this discussion. And yes, please do stay in touch. You can read about our work on our website, and we will pass on the questions that we received from the audience to your emails. Unfortunately, we were not able to get to some of them, or most of them actually. I'm sorry about that, but I hope you have a very happy festive season and take care.
Thank you.
Thank you.
Thank you.
Thank you.
Bye.